What if I told you that the next financial crisis might not start with banks, it might start with something most Americans have never even heard of, not the stock market, not housing, not credit cards, but a $3 trillion financial system, operating largely behind the scenes. And here's why that matters. If you have a 401k, a retirement account, a pension, or investments in the market, this story could affect you right now. Some of the biggest investment firms in the world are facing growing pressure, are requesting their money back. Funds are restricting withdrawals, and cracks are beginning to appear in areas that most people never pay attention to. At the same time, oil prices are becoming increasingly volatile. Government debt continues to climb. Hiring is slowing down, and artificial intelligence is beginning to reshape entire industries individually. None of these issues may seem catastrophic, but together, they could create a chain reaction that affects the entire economy. So today, we're going to break down what private credit really is, why some experts are sounding alarms, how oil, debt, and AI fit into the picture, and all of this could mean for your investments and financial future. Let's dive in. Before we talk about the risks, we need to understand one important concept. Leverage simply means using borrowed money. It's the foundation of modern finance. Most Americans use leverage every day without realizing it. Mortgage is leverage. A business loan is leverage. Debt is leverage. Even governments use leverage. The reason leverage matters is because it makes growth faster, but it also makes problems spread faster. Think of the economy like a giant row of dominoes. When everything is working, leverage helps push growth forward. But if one important domino falls, the effects can spread much farther than expected. That's exactly what happened during the 2008 financial crisis. Only a relatively small portion of mortgages actually defaulted, yet the impact spread across the entire global financial system because everything was connected. And that's what makes today's situation worth paying attention to. Most people have never heard of it, but it's become one of the fastest growing areas in finance. Here's how it works. Traditionally, businesses borrowed money from banks. Banks are heavily regulated. They must follow strict lending rules. But over the last 2 decades, a parallel lending system has exploded in size. Instead of banks making loans, private investment firms stepped in. These firms lend money directly to companies, commercial real estate projects, and infrastructure developments. The biggest players include firms such as Blackstone, Apollo, Global Management, Blue Owl Capital. The money often comes from pension funds and companies' retirement accounts. Investors over time. This market grew to roughly $3 trillion. The problem? Many of these investments are difficult to sell quickly. When investors suddenly want their money back, fund managers can't simply press a button and liquidate everything overnight. That creates stress, and recently, several major firms have reportedly faced growing redemption pressure. In simple terms, people are asking for their money, but the money is tied up in long-term loans. That's why analysts are watching this market closely. Here's something most people misunderstand about financial crises. They rarely begin everywhere at once. Usually, they start in one corner of the system, then they spread. Imagine buying a $500,000 home with only $50,000 down. You control a large asset with a relatively small amount of your own money. That's leverage. Now imagine the home's value falls by just 10%. Your entire equity position can disappear. The same principle applies across the financial system. Households use leverage. Businesses use leverage. Banks use leverage. Investment funds use leverage. Governments use leverage. When stress appears in one layer, it can quickly affect the layers above it. That's why economists pay close attention to seemingly small problems. Sometimes they're not small at all. Another trend investors are watching closely is artificial intelligence. Let's be clear. AI is creating opportunities. It's improving productivity, and it's helping businesses become more efficient, but major technological shifts also create disruption. Historically, New technologies often eliminate certain jobs, while creating entirely new industries. The concern isn't that every job disappears. The concern is whether enough jobs could be affected simultaneously to slow economic growth. Many analysts believe the most vulnerable sectors include administrative work, finance, customer support, data, professional services. Enough positions are displaced faster than new opportunities emerge. Unemployment could rise, and higher unemployment affects everything. Consumer spending, housing, demand, business investment, tax revenues. That's why the AI transition remains one of the biggest economic questions of the decade. Now let's talk about something that has preceded many recessions throughout history. Oil prices. Why is oil so important? Because oil affects almost everything. Transportation, manufacturing, shipping, food, production, energy. When oil prices rise sharply, businesses face higher costs. Eventually, those costs reach consumers. Historically, many economic slowdowns have been preceded by major oil shocks. The challenge today is that central banks have less flexibility than they once did. If inflation remains elevated while economic growth slows, policymakers face a difficult balancing act: support growth or fight inflation. That's the dilemma investors are watching closely. Another issue attracting attention is government debt. The United States currently carries one of the largest debt burdens in its history. Each year, trillions are collected through taxes, trillions more are spent. The difference adds to the national debt. As debt grows, so do interest payments. That means a larger portion of government revenue goes toward servicing existing obligations. The concern isn't necessarily today's debt level. The concern is the long-term trajectory. If economic growth slows while borrowing continues to rise, future policymakers may face increasingly difficult choices. This is one reason investors pay close attention to fiscal policy and government spending trends. Does all of this guarantee a recession? No, absolutely not. Markets could continue growing. The economy could remain resilient. Technology could boost productivity. Inflation could continue falling. But what we are seeing are multiple pressure points appearing at the same time. Private credit, government debt, oil prices. Labor market shifts. AI disruption. None of them may cause major problems alone. They deserve attention. Here's the biggest takeaway: financial crises rarely arrive with a giant warning sign. They often begin with small cracks that most people ignore. That's why understanding the economy matters, not because we can predict the future, but because we can prepare for it. The smartest investors don't panic. They stay informed. They diversify. They manage risk. And they focus on long-term financial goals. Because whether the economy booms or slows down, financial awareness is always an advantage. Comment below. Do you think the biggest risk to the economy is debt, AI, inflation, or something else entirely? If you found this breakdown helpful, hit the like button, subscribe for more finance, investing, and economic analysis, and I'll see you in the next video.